Good morning, good evening, good afternoon, and welcome to the Booms and Bus Show. My name is Jonathan Davis. I'm recording this on Tuesday morning, the morning after the night before. Je suis Charlie. I am Paris. I am India. I am Tel Aviv. I am Orlando. I am Brussels. I am Nice. I am Munich. I am Berlin. I am Westminster. I am Manchester. I am tired. 22 daughters and sisters, and the flaming media getting at the politicians who are talking about people creating divisions or saying we need to move on. 238 civilians murdered by Islamists in France since 2015. Belgium's terror list has gone from 1,900 to 19,000 since 2010. It strikes me that anti-Semitism is the spreading of lies about the Jewish people and the Jewish state. Islamophobia is telling the truth about Islam. Imagine 5% of your country were Nazi agents. Imagine your government and media punishing those who speak out about Nazism. That's where we are, folks. Enough said about the absolute terrible atrocity that took place a couple hundred miles north of where I'm currently sitting. It's Tuesday, the 23rd of May. Donald Trump was promising every single day for about 2 years that he was going to drain the swamp. Well, it's clear to me that Donald Trump most likely is the flaming swamp. It's astonishingly fast that every single one of his foreign policy reversals on NATO, Russia, China, Syria have been applauded by the mainstream media. It's pleased the establishment of the US foreign policy community. You should decide for yourself if that's reassuring. You know, the amount of people killed on US soil by terrorists from Iran, 0. From Saudi Arabia, 2,369. His first overseas trip, his first visit, the first time he sets foot on foreign soil, he goes to Saudi Arabia and sells them $100 billion of arms. Saudi Arabia is the biggest funder of global terrorism. Who the hell do you think funded the mosque from which the depraved killer last night came from and learnt all his garbage? Trump bombed Assad in Syria, who is fighting ISIS. Trump doesn't prosecute crooked Clinton and her cronies. He goes after Julian Assange. He goes and says that Edward Snowden is a vermin. Snowden is the greatest American alive. They go back and put the back on the war on drugs. And it appears that he's about to appoint ex-Senator Joe Lieberman as the head of the Federal Bureau of Investigation. This guy is so against liberty and free speech, you can't imagine. This is Donald J. Trump, who's going to drain the swamp. Every single thing he said he was going to do, he's broken his promise. Now, why is it that everyone who knows anything knows that Seth Rich, who used to be a communications guy, a media guy for the Democratic National Committee, who was murdered, and everyone knows that he provided all the stuff about Trump to WikiLeaks and stuff about the Democrats to WikiLeaks. How come everyone knows this, and therefore that it wasn't the Russians? How come they're not investigating the leaders of the Democratic Party for the murder of Seth Rich? Which, if it happened in China or Nigeria or Venezuela or Turkey or Saudi Arabia or any of those Middle Eastern countries except Israel, we'd shrug our shoulders. Some of us might even smile and say, ha, doesn't happen here. How come Trump isn't investigating? All I can say is Donald Trump has 2 final chances to drain the swamp. Firstly, the White House is putting out the message that they're looking at $1.7 trillion of spending cuts, indeed welfare cuts. Well, Donald, if you even come close, then okay, you'll get some brownie points, because that, without a shadow of a doubt, will help the US economy. It will also hurt the elite far, far more. Think it through, listener, for 10 seconds. It will hurt the elite far more than it hurts those receiving the welfare. Think it through. The second chance that he's got is to do with the Federal Reserve. At the moment, if I'm not mistaken, there are 3 places on the Federal Open Markets Committee which are lying empty. This is the crowd, like the UK Monetary Policy Committee, this is the crowd that sets interest rates and quantitative easing and all the nonsense. Now, Obama deliberately didn't fill those spaces because he wanted to leave it to Clinton and fill the swamp even more than he and George W. and Clinton and George Bush before had filled previously. On top of that, on top of the 3 spaces that are free just now, a couple of the current 5 members, I think it is, off the top of my head, are due to retire this year or over the next 12 months. Thus, Trump could put 5 of, or will put 5 of his own appointees onto the FOMC. In this way, he could mark his stamp on the US and the global economy and the future, therefore, of the world economy for, I would suggest to you, probably the next 10 years. And if he appoints sound money people, then, yeah, ultimately, I will happily wash away every other sin that he makes, that he's been making, and that he will make. If he were to put 5 sound money people into the FOMC. Even if he put 4 in, I would be very happy. Less than that, all he's doing is filling the swamp. And this nonsense that the media and indeed the White House fuels, that, any moment now, every time he opens his mouth, he's going to be impeached. Every time he looks at a woman, every time he says the word loser or pussy or whatever, he's going to be impeached. Is he hell? It's mathematically impossible. From during the Obama years, the Democrats lost 13 Senate seats, 69 in the House of Representatives, 11 state governorships, and on top of that, 30 seats from the various state legislative chambers, the Supreme Courts of the states. There is no possibility of Donald Trump being impeached because the Republicans, with a 47 majority over the Democrats, will never let it happen, even though many of the Republicans can't stand the sight of Donald J. Trump. It isn't going to happen. Now, I've tremendously enjoyed you contacting me by email at jd@theboomsandbustsshow.com and also tweeting with me at boomsbustshow. And please continue to do so. I want to particularly thank Gary, who commented on the show and asked me a couple of questions. The first thing is to do with something I talked about last week, which was US Treasuries, how they're hot to trot, and indeed they're picking up nicely. But I want to make clear that when the TLT fund, which is the fund of 20 plus year US Treasuries, when it gets up to about $130, it's in the low 120s just now, that is a hugely pivotal point. And I want you to think again about how government bonds work. When the bond price rises, it's because the interest rate associated is falling. When interest rates rise, the bond price falls. The maths are really very straightforward. And the bond price is currently rising, I would say to you, since quite recently, last couple of weeks. And it fell, 15-20% or so from the summer of last year till very recently. It only has to rise perhaps 5-6-7% up to $130, but that's hugely pivotal. At that point, we will know what indeed is going to be happening over the next probably few, maybe even several months. I wouldn't be surprised actually to see US Treasuries fall from that point and interest rates rise. This is the interest rate at which the US government borrows money. And what I was saying was, if you're investing in US Treasuries, and certainly in the coming recession, whenever that is, it seems very likely to me, as has happened every time in the last 40 or 50 years, whenever there's been a significant slowdown, indeed recession, government bond prices have gone through the roof because, of course, it's deflationary, and in deflation, interest rates fall. Government bond price rises. So I said, you want to be in US Treasuries because A, the pound would be likely to fall against the dollar, so you want to be in dollar-based assets. You want to be in assets which rise in a deflationary period, government bonds, US Treasuries, and that way you'll not only get the gain from government bonds, but you'll get an extra gain, because if you're a pound-based investor or a euro-based investor or practically any other country actually based investor, apart from, I would suggest, this Swiss franc, then you'll get an extra bounce from the growth in the dollar-based asset. But what I was saying was, in the short term, with the pound generally rising, this is now, today, or not today, the last couple of weeks, next few weeks, with the pound generally rising against the dollar, if you want to be in government bonds just now, then you want to, sure, you can be in US Treasuries, but you can hedge into the pound so that you don't first of all gain on the rise in US Treasuries, but then lose that gain because the pound is rising against the dollar. And there are ETFs, there are financial instruments out there where you can invest in US Treasuries and hedge against a falling dollar. He also asked me what books are good to read to learn the basics about economics. I thought it was an absolute brilliant question, and I actually widened it, and I gave him some books which are about that, but also about markets and indeed just generally understanding what the hell is going on. The most important trading book that I know of is Reminiscences of a Stock Operator, which, if you just give me 2 seconds, Lefebvre, written by Lefebvre. I was just looking on my bookcase, I couldn't remember the name of the author there. And that was written in the early 20th century, and it's as brilliant today as it was then, because as the protagonist, should I say, Jesse Livermore, an apparent incredible trader who won and lost fortunes in the early 20th century, said, it's never different. People's psychology never change. Markets never change. And my goodness, that is so, so true. So that's the first one. If you want to learn about economics and indeed about society, then read Hayek, Nobel Prize winner Hayek's The Road to Serfdom. It was written in the late 1940s, and it was essentially a treatise against communism. There's no question, it's absolutely supreme. It's a bit complex, it's difficult to read, it's written in language from the 1940s, pretty academic, but if you want to learn about the real economics, real markets, where governments don't intervene and why they shouldn't, then that's the one you should read. And indeed, you'll also get there as to why, what happens when governments do intervene. Much more modern, just written indeed a few years ago in very accessible language, is Dominic Frisby's Life After the State. And in there he explains why Cuban parents want their kids to be prostitutes. I can just see sales of his book trebling over the next few days. You should, without a shadow of a doubt, receive, if you're not already receiving, my Booms and Busts report. If you're not getting it, make sure you send me your email address. Send it to jd@theboomsandbustsshow.com. You will never be junk mailed. Read anything really by Jim Rickards. He writes a lot about gold. He writes a lot about where we're heading. His recent book is The Road to Ruin. He's written about currency wars, the new case for gold. He's an excellent writer and commentator. You can read anything by Rickards and you'll do well. If you're not following me on Twitter at Booms Bust Show, then what the hell are you doing? You have to follow me there, because I write and retweet a lot about what's going on. And then finally, Economics in One Lesson by Hazlitt, Hazlitt. So there is a really good selection for you. Economics. I'm still, I can't get over my grief when I woke up this morning and I saw the news. So I'm doing this show with a heavy heart, and as you heard at the top of the show, and you'll hear at the bottom, there's no music today. Derivatives. These are weapons of financial mass destruction, according to Warren Buffett. And I'm looking at a table here, and as you know, I'll tweet this along with the iTunes tweet of the show. I'm looking at the top 10 holdings of banks holding derivatives in the world, and essentially they're insurance contracts. They're insuring another institution that something won't happen. And in theory, what should happen is one institution takes out an insurance for something going up, and the same institution takes an opposing derivative for that something going down. So, the idea behind it is, therefore, everything's in balance, everything's cross-insured, not a problem. What a load of balderdash. Because all you need is one tiny, small counterparty somewhere in Tahiti, goodness knows, 10 years ago it was Iceland, to fall apart, and all of the interconnected spider's web of the global derivatives, like, you see these 100,000 what do you call those little things that the game dominoes, goodness me, you see the dominoes falling down very swiftly, one after the other, until it gets into a great big crescendo, like the biggest firework at the end of the night. Well, at the top of the table, you've got Citigroup, which is like Citibank and so on. And it's got total derivatives of $47,000 billion. $47 trillion. This is a US table, by the way, because Deutsche in Germany, obviously, has even more. But Citigroup's got $47 trillion of derivatives on their books. Now, think about that. To create that literally astronomical amount of derivatives and get fees on the whole lot, do you wonder how bankers make so much money? $47 trillion, and yet their assets, in essence, the capital that they've got to run their business with is $1.8 trillion. they've taken in investment money from pension funds, from sovereign wealth funds, from hedge funds, from private individuals, $1.8 trillion. And they have used that, they've leveraged it up and up and up. So much so that in fact it's 26 times their assets. That means that those derivatives only have to go down 4% and it's bankrupt. JP Morgan, 19 times. Listen to this. Goldman Sachs, 48 times their total assets. And the leader of the pack isn't even Goldman Sachs. It's a Japanese bank in America, Mitsui Americas LLC, based in New York. Its derivatives on its books are 121 times its total assets. So all those derivatives have to do is fall 0.8%. Now, I don't know about you, but that's extremely likely. 26 minutes. Now, there's a chart there of M2 velocity for the four major economies, the US, the Euro. How's the Euro an economy? Well, it will be, I suppose, when it all becomes the United States of Europe. Japan and China. M2 velocity. This is the rate at which money moves around the system and is used again and again. So, you know, if $1 out there is spent and then the seller uses that dollar on something else, who uses it on something else, and so on and so on, that's basically the velocity of money. And as you can see, over the last 20 years, velocity of money has been falling considerably and sustainably. And indeed now, and it goes along with the following chart, US velocity is the weakest on record. In other words, every pound, every dollar, every euro that's being used is being used less and less in the economy, which means to pretend that everything is basically okay, they have to create more and more and more free money. And that free money isn't going to the people who need it, it's going to the richest in society. And it cracks me up that when I talk about let businesses go bust, let the recession happen, let's have a clear out, let's see asset prices collapse, it cracks me up that practically every single person who hears that calls me Beelzebub. When the reality, listener, is that the system keeps the rich getting richer and the bottom 90% staying static or getting poorer. The bottom 90%. My way, the rich would be hammered, giving the bottom 90% more of what there is. But because it's quite complex, people don't care about thinking through the issues, they'd rather just feel. Remind me about that just feeling about people like me at the end of the show when I do the quote of the week. I see that UK real as inflation adjusted average weekly earnings growth over the past 15 odd years has turned negative, and indeed it's for the last roughly 9 years real average earning growth has been more time negative than positive. Only 2 years in the last 9 years has real average weekly earnings growth been positive. As I say, the bottom 90% are toast because of what central banks and politicians are doing. Let the thing collapse. It'll hurt not just the elite, it'll hurt the top 10% far more than anyone else, and the anyone else will actually find that their costs of living and the cost of doing businesses will plummet. How on earth will that be bad for them? On top of earnings growth is negative and has been mostly for the last 9 years, the UK household savings ratio has plunged to the lowest level in over 50 years. So next time we go into recession, no one's going to have any buffer. Great. Don't listen to me. What do I know? I know nothing. The next item I'm going to talk about happens before the next recession has set in. In English and Welsh county courts in the first quarter of 2017, we have seen nearly 300,000 debt judgments filed against individuals. This is the highest quarterly figure for more than 10 years. Doesn't more than 10 years include the recession of 2008? Figures from the Registry Trust show a 35% rise compared with Q1 of 2016 in county court judgments against borrowers who found themselves unable to pay their debts. I reiterate, it's before the next recession. It's with borrowing rates at all-time lows. The Trust, which compiles the figures on behalf of the Department of Justice, said that Wales, in the first 3 months of 2017, also had the highest figure for single quarter in over a decade. And then what we see is UK households borrowed a record £31.6 billion last year to buy cars, up 12% on the year before. 90% of private buyers use personal contract plans, PCPs, to make their purchases. This year, the total to borrow is expected to exceed £40 billion. Well, that of course assumes that we don't see a recession this year. A team inside the Financial Conduct Authority, the overall regulator, what they call it the main city watchdog, has begun drawing up the terms of an inquiry into how much banks have lent to car buyers and the likelihood of these institutions getting their money back. Horse, barn, door, closing after bolted. Top 10 banks in the UK. Number 9. Come in, number 9, your time is up. It's now, well, I'll tell you what it's seen. It's seen a 30% increase year on year in mortgage lending. It is equivalent to the Yorkshire Building Society, but it's not a bank. It's not a building society. It is the Bank of Mum and Dad. Earlier this year, I remember reading that a quarter of home purchases used the Bank of Mum and Dad. A quarter. And I remember reading also that a third were with foreign cash and a third were Help to Buy. Oh, well, that's all right then. Finally, in economics, just note this, and you consider whether or not this is likely to end well. 2007 to 2017, residential property prices. Sweden, up 70%. Australia, up 74%. Canada, up 82%. China, the second largest economy on the planet, up 155%. Incidentally, because it includes the crash of 2008, the subprime mortgage crash, from 2007 to 2017, America's overall national average house price has fallen 4%. Fine. Well, that means, by the way, that house prices are more accessible for Americans, although obviously not in the likes of Seattle, New York, San Francisco, and so on. But, more or less across America, if you want to buy a house, you can buy a house. That doesn't make them cheap. It just makes them the same price as 2007, give or take 4%. Doesn't make them cheap. And what's interesting is, if you think about that, in America, the national average price peaked in 2007, fell, I think, some 50%, but then has risen dramatically on average in the US in the last several years, and we're back up to more or less the peak in 2007. So, I'm not saying they're affordable, I'm saying you can buy. But what's interesting, and this is so incredible, all they've done is got back up to where they were at the peak in 2007. And that's with effectively no cost of borrowing. And that's with massive bailouts. And that's after a crash. And that's 8 years into economic expansion. One of the longest expansions in history, as I explained the last week or two, although the weakest recovery in history. Longest in number of months, weakest in percentage growth. And house prices are only back to the peak of 2007. They can never slash interest rates again. We are going to go into recession at some point. In that recession, house prices will fall 20 or 30%. They can't slash interest rates. They've had 8 years of economic growth. I say to you, again, I can't see how in America house prices are going to be any higher than they were in 2007 for 20 years. You bring that to Australia, Canada, Britain, where we had a 20 or 30% fall in prices in the crash, in the recession, but then they came back straight back up again, and some, because we didn't have the house price crash that some other countries had, we've still to have it. And if America is not going to see house prices any higher than 2007 for 20 years, what on earth makes you think that we will see higher house prices in the UK, for example, in 20 or 30 years' time, when we haven't had our big crash yet? And if you're a property investor, first of all, you've got Section 21 to deal with, the higher taxes. But even if you're not a property investor, if you're just a normal home buyer with a big mortgage, or if you're a retiree depending and relying on the price of your house to bail out your financial, bail you out financially in retirement, I suggest strongly you rethink that strategy. And if you haven't bought yet, consider very carefully about buying that house with a whatever, even a 75% mortgage, or more to the point, 95%, including Help to Buy. Consider whether or not it's actually worth your while over the next 20 years. Don't think of it in terms of the monthly cost today or the next couple of years. Consider it very carefully over the next 20 years. Now, I've been talking about the dollar a lot. I've been saying that since the beginning of the year, the dollar's going to be toast, or at least it's going to fall 10 or 15%. There's a chart of the US dollar index. It's broken below, as you can see, a very important support level. It's down 5 or 6% since the start of the year. That's the dollar against a basket of currencies. This, of course, is commodities bullish, and I've been very bullish on gold miners, and indeed, the last couple of weeks, they've done really, really well. But nothing goes in a straight line. The daily sentiment index for the US dollar is only 5% bullish, which means, of course, that it's 95% bearish. We have an extreme bearish sentiment on the US dollar. It's unsurprising because in the last few weeks, the dollar has been pummeled. And, you know, if you're a regular listener, you know that I've repeatedly said the euro's going up, the pound's going up, the yen's going up, the dollar's going to get hammered. It has been hammered, and the other currencies have done very well. Incidentally, of course, with the pound rising, do you hear anyone on the Brimone side of things talking about the pound? Funny that. And I find it interesting, however, that those on the Brexit side aren't talking about the pound, but by the by. Look, the dollar's not going to go down in a straight line. It looks to me as if it's actually going to rally now. That doesn't mean it's going to rally a hell of a lot. It'll be, I imagine, a lower high. The high, shall we say, was at the beginning of January at about an index level of 105. It's currently at around about 97. Actually, that's more of 5 or 6% fall. That's more like a clearly 7 or 8% fall. So if the dollar rises, expect it to be short and sharp. The pound will fall sharply, as will the euro, as will the yen. And this is the thing. I've been uber bullish recently about gold and miners. I'm actually seeing them could well pull back over the next week or 3 or maybe even 4, well into June. And I know this is highly contrarian, but there you go. Nothing goes in a straight line. In fact, I think we might even see small gold miners heading down towards the December lows, which will still be higher than the January 16 lows. But you know what? It seems to me that this shakeout of short-term Johnny-come-latelys who are buying into gold and miners because they're seeing the dollar go down, it seems to me as this is going to be the shakeout of shakeouts. And it is going to lead to an absolutely astonishing rally in gold, silver and miners once this shakeout ends, somewhere between 1 and 3, maybe 4 weeks. So just bear that in mind. It doesn't change the big picture, but it does change the small picture. Another reason why I say that is it's a bit complex, but I'm sure you'll be with me, listener. Since yesterday, and indeed we had inklings of it on Friday, real rates are rising. This is essentially inflation-linked government bonds relative to nominal government bonds. Oh God, what on earth are you talking about, Jonathan? Well, you can buy government bonds which are inflation-linked, and you can buy them which are nominal. Early in the show, I was talking about buying nominal, and indeed they go up when inflation goes down. And inflation-linked ones obviously go up when inflation goes up. Well, there is a sign that real interest rates are rising since literally a day or two ago. And in that scenario, you do not want, particularly if you're leveraged, if you are leveraged, I don't know why you're leveraged, but if you are leveraged and you're looking at short-term plays, but that's not really what this show is all about, then yes, I can see a case for gold and miners coming down pretty hard over the next week or three or so. If you are heavily leveraged, at the very least, you ought to reduce your exposure. You've done very well in the last couple of weeks. Lock in many of those gains. Now, looking at stocks in general, there's a chart there of the bull and bear indicator from the Bank of America Merrill Lynch. And when it's extremely bearish, that actually is when you ought to be getting bullish. And when it's extremely bullish, as it happens, it doesn't mean that you go short. Perhaps what you do is you reduce your exposure to stocks. And we see the daily indicator getting rapidly up into an extremely bullish level. That doesn't mean that you go short the market, but if you are heavily long the market, you might want to, stock market, you might want to be trimming. That I would say to you. And there's a chart of German business confidence, and it's at a similar level to 2011 and 2007, just before stock bear markets. Doesn't mean there will be a stock bear market, but as you well know, I've been talking about particularly the S&P, and that basically means the FTSE and the DAX in Germany and the like, going down 10 or 15%. Okay, it hasn't happened yet, but it's still hovering around from when I first said it way back in March. We're now towards the end of May. So we haven't had any rises in the spring. We had a fall. We'd have a rise back to where it was. I'm still clear. We're looking at a 10 to 15% fall generally in big stock markets over the summer. Going back to government bonds, and there's another market indicator that you should all know about if you've got money invested in markets for your pensions and whatever. It's the yield curve. It's how does the market see interest rates going forward for different durations of lending. What's the interest rate if the government borrows for 30 years? What's the interest rate if it borrows for 10 years? What's the interest rate if it borrows for 5 years, for 2 years, for 1 year, for 3 months, for 1 week? And the indicator that I look at is the 10-year rate minus the 2-year rate. And if you look back in history, when the 10-year rate minus the 2-year rate went negative, in other words, the short-term borrowing rate was higher than the 10-year rate, the long-term rate, that actually signalled we were in depression. Because interest rates in the future were expected by the market to be lower than interest rates currently. In other words, they expected deflation in the future. Well, deflation in the future compared to today is clearly the market saying recession. Now, early last year, the level got down to 1.2. The differential was 1.2, which meant that 10-year rates were 1.2% higher than 2-year rates. And I was saying to people, particularly to clients, should I say, that, the 10 minus 2 rate is falling. I can see it going sub 100 basis points, which means sub 1%. And then it's heading towards 0, and then it goes negative. And indeed, it got down to 1.2 in early 2015. And by the middle of 2016, it got down to 0.8. It then rose in the reflation from the second half of last year up to about 1.35. Listener, it's below 1.0 again. It's at 0.95. Now, does that mean it's heading down to 0? Well, at the moment it is. It has crossed the crucial level, as far as I see, of 1.2. It's gone below 1.2. It's below 1. Let's see if we get a lower low compared to summer last year of 0.75, 0.8. Let's just see. Nothing goes in a straight line. But I'll tell you what, listener, if it goes below 0, we're going into recession. And certainly, it's going in the right direction for a recession. And certainly, even though it's not at the lows of summer last year, it is trending down. It had been trending down since early 2015 with lower highs and lower lows. Another reason why we could be heading to recession. I want to move on to the market's forecast for something like $100 billion fund management company, GMO, in America. And I'm just trying to remember off the top of my head, I've just forgotten his name, unfortunately. Hugely influential and indeed massively successful 40-year in Grantham, Jeremy Grantham, just come to me. Jeremy Grantham, 40 years ago, he and Mr. M and Mr. O set up GMO, and it's amazing how often Jeremy Grantham, Chief Investment Officer, has been right on the big picture. There's a chart there which showed GMOs, in other words, Jeremy Grantham's forecast for the next 10 years of various asset classes investment expectations on returns, starting from the 1st of January 2000, or indeed the 31st of December 1999. And he said, or they said, that the S&P 500 would make a real return, inflation-adjusted return over the next 10 years until 31/12/2009 of minus 1.9% per annum. You know what the actual return was? Minus 3.5% per annum. He said that emerging markets would make 7.8% per annum. It actually made 8.1% per annum. Absolutely remarkable foresight. US government bonds, I'm looking for them. Yes, US government bond. He said over 10 years it would make 3.8% per annum. It made 3.5%. It's remarkable. I don't know anyone else who does this and does it so well. Now I come to, as of April the 30th, 2017, it's only 3 weeks ago, Jeremy Grantham and GMO have published their forecast for various asset classes, 7-year return forecasts. I trust you're sitting close to your device and listening intently. I believe I have your attention. Have you ever seen the movie, one of my all-time top 10 films, Glengarry Glen Ross? You haven't? Well, I'll tell you. It's got Al Pacino, Jack Lemmon, Alec Baldwin, Jonathan Pryce, Kevin Spacey, Ed Harris, who's the guy who was in with James Caan, Alan Arkin. I mean, it has the most amazing cast, and the script is as tight as, well, you know what I mean. Just go onto Google and search for Alec Baldwin's sales speech. Oh my God, it will blow your mind. And if you have watched it, then you know exactly what I've just been talking about. Glengarry Glen Ross. Listener, you have to watch it. I'm reminded of it because I just said, have I got your attention? Right. Stocks. GMO forecast the next 7 years growth on US large cap, the S&P 500, which basically means, to a large extent, it means the FTSE as well and the DAX, although I'll caveat that in a moment. Outlook per annum over the next 7 years, minus 4% per annum. International stocks, actually not as bad as I said, minus 0.7% per annum. Emerging markets, 3.4% per annum. Government bonds, they're expecting a fall of 1% per annum. Anything else of interest? He doesn't seem to talk about... no, he doesn't talk about commodities. That's a shame. I wish he had done. But if you're in an equity bond portfolio, you're toast. Quotes of the week. From Dominic Frisby, I mentioned him earlier. You could spend $1 million every day since the dawn of civilization, and you would have spent only about 1/3 of US national debt. And Thomas Sowell sums it up beautifully how I feel about the media today after last night. Quote, "Emotions neither prove nor disprove facts. There was a time when any rational adult understood this, but years of dumbed-down education and emphasis on how people feel have left too many people unable to see through this media gimmick." Unquote. Listener, thank you for listening. I'll see you next week.